Altria Group, ticker symbol MO, is a favorite among dividend investors due to its massive 9.69% dividend yield. The stock is currently trading around about $40.46 a share and is down 9% over the last year. What we're going to be doing today is looking at the stock, looking at what the stock price has been doing, and then going to my automated stock valuation spreadsheet where I'll be looking at the company's financials, then valuing the stock based on discounted free cash flow model, the comparable company model, and then the Ben Graham formula for value investing to see if the stock is a buy or a sell. If you're interested in the sheet, please check out my Patreon, links are in the description. Anyway, let's have a look at Altria Group. Currently, as said, it is trading at $40.47 a share. It has earnings coming up later this week, so this could be a big time for investors to buy. Although if we do look at the stock price over the last year, it is down almost 9%. If we take this back over 5 years, you can see it's been pretty up and down, currently down about 17% where it was this time in 2019. It did have a bit of a resurgence back in 2022, but is down almost 28% since then. If we were to compare versus the market at that time, a very similar story where the market has substantially beat Altria Group in that time. Unless you were an investor from back in the day, and then you would be very, very happy. But this stock has a massive dividend, and this is one of the reasons that people like this stock. Let's have a look at my automated stock valuation spreadsheet. What we do here is we just put in the ticker of MO, and what this will do is load up all the company's financial data, and then we can do some analysis on the stock. So as we can see here, price of $40, market cap of 71 billion. It has a very low P ratio. This is price to earnings ratio of 8.62 with a market average from anywhere between 20 to 30. This is substantially lower than the market average. It also has a earnings per share of $4.90 and a beta of 0.64, which means this is not a very volatile stock. As we saw over the last 5 years, it was up and down, but very, very consistent about that time. 1.8 billion in shares. We'll talk about shares in a minute, and the target price of this stock, according to analysts, is $46. Dividend. This is why people like it. 9.39. Obviously, it's upgraded now to 9.69, depending on the price. This means you will get $3.08 per share. Now, the total dividend they pay out is $6.7 billion. In terms of payout ratio and free cash flow payout ratio, this is on the higher side of 76 to 79%. The ex-dividend date, so if you want to get paid the dividend, buy the shares before March 2024. So we have here the revenue, net income, free cash flow, and shares outstanding. What we'll do is we'll have a look at these over the last 10 years. First, we've got revenue. Revenue has been very, very consistent since almost 2009. You can see they've always consistently had about $24 billion in revenue, which is obviously not too good. You want to see that increasing, but you can see the consistency in this company. Next, we want to look at net income. Net income is all over the place. They had very good years in 2016-17. Looks like some trouble with COVID, but have really back to that $5.7 billion. One of the things where they do reward shareholders, though, is the buying back shares. Why is this good for investors? Well, if you have one share in a company and there's 10 shares outstanding, you own 10% of the company. If they buy back 5 shares, they would now only have 5 shares and you would own 20% of that company. And basically since 2009, they have consistently been buying back shares, so that is their way of rewarding shareholders. They have been using their free cash flow, which we'll see here if we go on the free cash flow chart. Let me flip this around actually, because we want it this way, the other way, sorry. We want to see the future. With their free cash flow, they have about $8 billion in free cash flow, as we saw with the payout ratios earlier, and they're using this to pay dividends and buy back shares. One thing I did notice, though, I saw this on another channel or another comment channel, is to look at the assets versus liabilities a bit more. And you can see here, Altria has quite a lot of liabilities compared to its current assets, and this liabilities has increased quite dramatically over the last couple of years, but the assets have stayed relatively flat, around 6 to 7 billion, but they're up to 41 billion in total liabilities, down from 2020 though. So let's get into the stock valuation. This is the discounted free cash flow model. This calculates the future free cash flows, discounts them to today's value, and then this will give us a fair value of the stock. So let me just have a look at these numbers. Yes, now this is on averages. It has a calculated stock price based on the averages of $43 a share, which would say it is a buy. Now, normally what I do here is I have a look at the numbers and see if we think this is correct. So one thing we want to look at is the revenue. Revenue, I would say, is pretty flat. They're expecting decreasing revenues over the next few years. So what we'll do is we'll set this to 0. In fact, actually, what I'll also do, if we have a look at what analysts are saying for revenue over the next few years, then we can incorporate that into our sheet. So on the high side, they are expecting a decline again, 19.3. So let's close that down. I'm pretty happy with the numbers there. Let's actually go with the averages as well. So minus 0.2. Next, we want to look at the net income margins. Net income margins have been pretty consistent, though I think the 16 is a bit low. You can see they're up to 36. So let's increase that to the previous number of 24, which is a little bit closer to these averages. In fact, if we were to take average directly, that is 22%. So let me put in 22. Now that puts it up to a $56 stock based on that. And then the net income to free cash flow. Let's also, I'm pretty happy with 76. I mean, these numbers are a bit all over the place, but let's go with 76. So discounted free cash flow actually says this stock is a buy at $56 a share. So obviously undervalued based on discounted free cash flow. Next, we want to have a look at the comparable company model. This looks at basically comparison companies, uses the metrics, and then we'll have a look at those differences. So the examples that I chose was Philip Morris International, ticker symbol PM, British American Tobacco, BTI, and Universal Corp, which is another cigarette company, UVV. Now, if you look at the equity value of these, the most direct comparison is British American Tobacco with 66 billion. Philip Morris is a bit, in fact, Universal. Let's not even look at Universal. Let's look at this one. So what we do in here is we look at these metrics, which is revenue, EBITDA, which is earnings before interest, tax, depreciation and amortization, net income, EV to revenue, EV to EBITDA, and PE. And with all of these multiples, really we are looking for lower numbers. That is normally the better case. So if we were to see this here, we can see that Philip Morris is the highest on all three of these, and Altria Group is kind of in the middle. So based on the comparables model, it is actually a buy on all three models, whether you look at EV to revenue, EV to EBITDA, or PE ratio with around $50 a share. Lastly, I'll have a look at the Ben Graham formula for investing. This is the formula that Ben Graham used to see if the stock is a buy or a sell. What this does is it looks at earnings per share, growth of a company, AAA bond yield, and expected growth rate. So let's see what analysts are expecting for Mo. I think this will not be good. Actually, 2.25%. So we'll include that here, 2.25%. And AAA bond yield currently is a bit high at the minute. I think it's probably about the same. Yep. And interestingly enough, a fair value of 42 and then kind of a Graham margin of safety of 37. So he would say it's a buy as well. So interestingly enough, all of the models are saying Altria is a buy. Personally, I think it's difficult with these stocks because tobacco is a decreasing industry. And if we're looking at the numbers here, the revenue has been pretty flat and it's not a growing company. But if you do like the dividend and you do think it's going to hold its price, then fair enough. But I think I would look at other stocks. Right, guys, thanks for watching. Please give a like on the video if you've enjoyed it. Subscribe if you're not already, and I'll catch you guys next time. Leave comments down below on the stocks you want to see.